Interest rates are rising, and many analysts predict an earnings recession. Yet stock valuations are above historical averages. So we're asking the Dean of Valuation, NYU Finance Professor Aswath Damodaran, to explain what's going on. Thanks so much for coming on the show, Aswath. It's great to have you back.
Oh, thank you for having me.
So let's start with the broader market. For years, bulls were justifying higher than average stock valuations by saying, well, bond yields are so low. Now, that's not true anymore, right. And some say that earnings may be going down from here, not up. So does 18 times earnings make sense right now?
No, I think we need to step back. At the start of this year, I said there were two forces that would drive what markets do this year. One was inflation and the pathway it takes to either becoming benign or staying malignant, and the other was what will happen to the economy. They're going to drive what the market does. And I think the question of whether we're going to pay 18 times earnings or 15 times earnings or 12 times earnings will largely be determined by whether inflation stays at 5% or drops to 2%.
Let's take a company that is sort of in the middle, I guess, would be Tesla. That valuation obviously skyrocketed, then it plummeted. Now it's up nicely over the past few months. How do you go about valuing a company like Tesla?
I think, from my perspective, it's an automobile company that has a tech component to it. So you got to give Tesla credit. They've reinvented the automobile business. They brought everybody else to play the game that they're playing. And in the process, they're creating a new story for an automobile company. Now, I know that Cathie Wood thinks that automated driving can double the price. I don't see the market for that.
So bottom line, it sounds as if you think that valuation is still a little high on Tesla.
This is a stock where I'll never get it right. I'll overshoot, I'll undershoot. I'm willing to buy Tesla at the right price. I think it is a special company. I don't think it is the greatest company ever to walk the face of the earth, as some of its true believers think it is. But I think it's a special company. I gave them a valuation of around $400 billion. But the way this company is priced right now, it's priced even higher. Market sees something that I don't. And until I can get some clarity on what that additional stuff is, I'm not willing to pay the premium.
And you mentioned Cathie Wood, so let's go there. She seems to think, correct me if I'm wrong, that innovation will justify almost any valuation. How do you make sense of what she's buying?
Innovation is not a business, right? Innovation is change. I've seen businesses be innovative and have terrible business models. I mean, remember the 1980s, PCs were the innovation of the day. Out of every 10 PC companies that were started, 8 went out of business. So we often mistake innovation and growth for profits and value. And I think what I find lacking in Cathie Wood's story is she has a good sense for trends and the macro, but her grasp of the micro leaves me gasping of, so how do you run an investment fund without connecting the micro to the macro? So telling me that everybody will buy electric cars, I'm willing to go along. But then telling me that an individual company will have an 80% market share of all electric cars sold, you got to do your work to establish that 80% market share. So when I look at Ark's recommendations, they're all built on macro stories. You're making macro bets, but without doing the work of connecting the micro, the company, to the macro story.
Wow, thanks for that. That's really helpful to break it down that way. I do want to ask you, we've been talking about growth here, which has been the story for, what, a dozen years, but suddenly value is having its day. How do you look at that? Do you see the valuations of value stocks as being more attractive right now?
I think there's a bigger story to be told. For a decade, we had so much risk capital sloshing around. It wasn't just low interest rates. It was that risk capital was so easy and accessible that I think we overcapitalized these young money-losing companies by providing endless sources of capital to young companies with terrible business models. We call them disruptors. That's, again, a word that somehow became a magically good word. Disruption. It's going to save us. But disruption has a dark side. You take young businesses that don't have good business models, you feed them endless amounts of capital, they're going to accomplish disruption. They're going to destroy the status quo, but they're not going to replace it. I mean, look at ride-sharing. Ride-sharing has disrupted the business. Taxi cabs are dead as a business. But ride-sharing as a business hasn't figured out how to make money. So it's not just growth that was being funded, it was growth without business models, and that's dangerous.
How do you apply your metrics to a country like China, where there are a whole bunch of unknowns, political risk, et cetera, that we don't have here?
Right. Whenever I value a company, I don't think of Excel spreadsheets. I think of a valuation story. I kind of told you my valuation story for Tesla. And in China, any company you pick, it could be a big or a small company. You can tell a story about a company, but there's a player in the room, a player in that story who you don't control, which is the government. I'm uncomfortable having the government be such a large player in whether I make money or not as an investor.
Aswath Damodaran, thank you so much for bringing clarity to some pretty complicated issues. We appreciate your being on the show.
Thank you.